Hey everyone, Jason Griller here from the Suncast team, helping out with Nico on the events of today. Wanted to introduce to you Jim Bowen from Energetic Insurance, who's going to be hosting a very interesting talk with on financial insurance products. So with that, here you go, Jim.
All right, thank you very much. And are my co-panelists here?
Yes.
All right, see them now.
Yeah.
So thank you, Jason. Thank you to the whole Suncast team for putting this awesome event together. And I think it's much appreciated by the whole community. So I have with me here Peter DeFazio from Greenprint and John Merritt from Verdant Commercial Capital. And someone might ask, why would an insurance company want to talk about tax equity and put it so important that they just want to talk about tax equity? Well, in the C&I solar space especially, we're finding as an insurer that tax equity is becoming even more important in 2020. It always has been, but deals just aren't getting done without it. And if deals aren't getting done, we don't have the opportunity to offer insurance. So I talked to Peter and John, who are two of the leading represent two of the leading companies in small and medium C&I solar tax equity. Super creative guys. They bring a lot of experience and track record in this sector, which is very different. Other panels I go to, I hear lots of large tax equity players or residential solar discussions, but not enough about the C&I space. And I think these are the two perfect people to talk about it. Before I turn it over to them to tell us a little bit more about what they work on, I also say, interestingly, Peter and John have a very they're targeting the same market with different approaches. So Peter is focused on raising tax equity from family offices and C corporations, and he does partnership flips. John Merritt raises from small banks, and he does sell leasebacks. And they're going to tell you about what are the differences and similarities between those two structures. And I'll say where we're really excited to take questions from the audience. Anybody that please, we're expecting to do that, and we can refer to them during the audience. Without further ado, and I should probably introduce myself briefly. We have a credit insurance product that covers against off-taker payment default risk on PPAs. So can be useful to protect tax equity investment or debt lenders on these deals. So without further ado, maybe starting with Peter and then going to John, if you could talk about what you each do, what is your structure, what are the benefits, and what types of projects are you best suited for, and what are not the best suited for your structures? Starting with Peter.
Sure. Yeah. Hey, this is Peter. Greenprint Capital is we've been here for about a year. We've been focused on the C&I sector. We use a partnership flip structure. In May, we started deploying capital on a one-off basis and quickly discovered that the programmatic approach is much more effective with sponsors. So moving forward, we've been partnering with developers on kind of a programmatic basis. We sign our partnership documents, and then we drop projects as we go, and that allows developers the flexibility to add and remove projects from the pipeline. So we'll write a hard commitment for a pipeline and work developers through tranching that. Our structure is for corps, family offices, high net worth individuals, so it makes us a little bit different. In terms of check sizes, because we have a kind of a diverse set of investors, we can write pretty small checks. We've done a portfolio of 12 projects, and I think the smallest individual investment was maybe $250,000. And then, we generally like to tranche in numbers bigger than that, but we're able to kind of address portfolios of projects that are comprised of rooftops, carports, ground mounts, and kind of adopt our structure for that. We have about $30 million in recurring tax liability, so we're not a big player. We are always actively fundraising, and I would say our ideal investor client is one of the ones I mentioned, so a C corp, family office, or high net worth individual. We don't work with a lot of bulge banks. Generally speaking, they're not that interested in working in the C&I sector unless they're with mega sponsors with big portfolios. So we found our niche in kind of this sector.
Great. And John?
Yeah, John Merritt, Verdant Commercial Capital. Just a little on Verdant for context. Verdant Commercial Capital was founded 2.5 years ago. We are an independent equipment finance company. We are our sponsor equity itself comes from a couple of family offices, and we've levered that with some pretty significant banking relationships. And we operate in 6 different vertical markets, 5 of which are not that relevant to this conversation, but one of which is the energy sector. It happens that in my background, I led the project finance team at PNC Bank before retiring from there to join a couple of colleagues and start Verdant. What is important to take away, though, is that Verdant comes from the equipment finance discipline, and thus we have an orientation, perhaps, for the sale leaseback structure. Verdant, being an independent and a relative startup, doesn't have a ton of tax equity on its own, so we have had to lever that with our banking partners, many of whom have never been in the solar space before. So our relationship with our banks are that we identified, out of the 20 plus banks that fund assets every day for Verdant, we identified 5 or 6 that were kind of regional players who had their own tax appetite sufficient to be meaningful, had an equipment finance subsidiary or at least a platform within the bank, and yet didn't know solar or didn't know real PPA or project finance structures if they were dabbling in solar already. So we spent time kind of bringing those new tax equity participants into the market, have been successful on a limited basis so far. We have garnered a lot of enthusiasm amongst those 4 or 5 players that did follow the lead here. And but as always, tax equity is the constraint in this marketplace, as our developers no doubt are aware, and as Peter is certainly also aware. So we are collectively looking at ways to expand the available tax equity, and then that subset of it that is interested in C&I projects to really focus down on that niche. I think Peter did a nice job of describing it as a niche. I look at it the same way. There is a fair amount of availability of tax appetite for utility scale projects or large portfolios from mega sponsors, but for developers that aren't quite that far along in their curve, it can be difficult and it can be challenging. We're sympathetic and empathetic to that need, and have been successful thus far in fulfilling it, and have partnered with Energetic on some live transactions to backstop one of the several risks that present to banks when the bank is the tax equity investor.
Great. And if for the listeners out there that might be interested in being tax investors or have connections to a bank or a certain corporation that could have that interest, do you guys have like a one-line memorable kind of, all right, if you have X, Y, and Z, go to Peter. If you have A, B, and C, go to John?
I'll let Peter respond first.
I'll take everything John doesn't want. So I think John's geared toward equipment financing, at least the way that he's described it. So my guess is that financial institutions that kind of have that background are better suited to onboard through him, especially since, John, you're employing the sale leaseback structure. And then take everybody else. I'll figure out what kind of structures work for those types of investors.
Yeah, I think, if you are a lending institution who already understands, loan products, maybe even secured term loan products, but you don't have a leasing company, you have to fundamentally embrace the operating lease if you want to become an entrant into this space through us. But nonetheless, it's not that long of a putt once one begins to digest, what does a residual mean? What are the components that make a good project, both economically and structurally? And that's what Verdant does, is try to educate our tax equity investors as to what to look for in a project. But then the other side of our house actually sources projects. We work with the developer community and helping them get their C&I projects done.
Great. And now from the other, so that was the investors who have tax appetite. From the other side, the developers and the installers who are originating the projects. Let's ask a fun question, since I have kind of two people with different specializations. What is the best structure between partnership flip and sale leaseback, or other? There could be another structure. What is the best structure? Debate. Who takes that one first?
Yeah, we are a equipment finance company, so we prefer the lease. That's just a penchant or perhaps an orientation. Let's rule out the inverted lease for the moment, because it's very, in my opinion, it's very limited in its application. But let's talk about the dichotomy between a sale leaseback and the partnership flip. For the sale leaseback, I think the primary benefit is that the transaction requires only a single investor. The tax equity investor and the quote debt piece of a transaction, end quote, that is the same entity. So really what we've done is simplified the execution. We only have one constituent to convince of the risk profile and return profile. And we try to model our proposals around the actual cash flows that developers present. And we try to size our lease just to fit into that, giving developers what they need on the front end in totality. Developers don't need to bring any of their own debt sources to complement the tax equity when you do a sale leaseback, but they do have to have projects that either on their face or with the right kind of enhancements, such as energetic, can meet a bank's credit standards.
Great. And could you talk just really quick, because you do it very well, that's the three areas of enhancement that you typically see are required on a lease, and why?
Sure. There's really three principal risks when you break down these solar projects. One is the performance risk of the project itself. In other words, what is the answer to the question, will the project produce the energy in line with the forecast that was put forth, which led to the cash flow models that were put forth, which led to the lease design, and therefore everything is predicated on that amount of energy being produced in quantities that measure up to the forecast. That's one element of risk. The other is, will the guy or the entity responsible to pay for that energy do so? That's credit risk. That's the kind of risk banks routinely underwrite, and they have to understand the unique nature of what an off-taker is versus a direct borrower or lessee. But nonetheless, that's part of the way we close the gap. The third risk is really tax recapture or a negative tax outcome. The sale leaseback has a feature in it called a tax indemnification, wherein the lessor is promised that if he bet on certain tax attributes coming from his counterparty, the lessee, that the lessee will not do anything to disturb those tax attributes, those tax benefits. And tax indemnification is usually something that the lessee or his sponsor, developer entity that might own a special purpose entity provides. And there are insurance enhancements that can backstop that risk as well. So all three components of that three-legged stool have to be appropriately designed, and the risks associated with them, mitigated. But that's what we do. We help solve those questions.
Great. And, I can't help but say, obviously, we're really keen on the credit risk. That's what we created our company for. And we're excited to help people think through the issue, how to mitigate that risk. We also can help you with both performance or tax indemnification insurance.
Yeah, and James, if I could, and I know we want to give Peter a chance to respond here, but I want to follow that theme here, because the two of us, our two firms, were the first that we know of, at least in the country, to partner on a energetic policy backstopping a sale leaseback. And so what I said earlier is banks are accustomed to taking that credit risk. That's what they underwrite. It doesn't mean they approve everything. The gap that we were able to close in that instance was that we made an otherwise non-bankable credit bankable. And not only did that facilitate getting financing in the first place, but it maintained the value of the project because those cash flows were not put into a category of even substandard risk. I mean, we had an investment grade backstop to the cash flows for what was, kind of a lower end middle market company.
Yeah, that's a great point. Thank you. And Peter, we'd be remiss if we didn't give you your shot, because I know you like this question. What is the best tax structure for C&I projects?
Yeah, well, I mean, inverted lease aside, I think that partnership flip gives you a lot more flexibility in how you structure the transaction. To John's point, I think the sale leaseback kind of brings everything together. We're a deconstructed view, and I think that in modern times, deconstructed, food, for example, is more attractive to people. So I think, from a partnership flip perspective, developers can bring their own debt provider. You can kind of shape cash with respect to the three different categories of risk that John spoke to. I think tax risk is probably the number one for us, because we're paying a price per credit to the project to invest in those tax credits. We're not taking as much cash. All of the cash is being given back to the sponsor and then back levered, so debt is still part of the picture. So I would say that a lot of our analysis is focused on the strength and the indemnity. And in the C&I sector, we realize that a lot of the developers don't have big balance sheets, so we're looking to the project for available cash flow in the event that there is a recapture event. From an off-taker's perspective, because we're a partnership flip structure, we're very short weighted average life, so we don't take a lot of long-term credit risk. That's the debt provider once again. So that, I think, makes it a key difference between investment structures. And then as far as operational risk, we take a preferred distribution of the cash ahead of the debt in many instances. So again, we're pretty insulated against all of the other risks. It's just the tax risk that we're very focused on. And I would say for us, it's really important with the developers that we're going to have a good relationship. The sponsor, we look at their asset management qualifications, because for us, it truly is a partnership, and we have to interact at least on a quarterly basis when we receive reports and distributions for at least the next 6 years. So we really want to make sure we're doing business with good actors that are going to deliver on their promises, and particularly on a reporting basis, because we have to go ahead and talk to our investors and keep them informed. And if we're not being informed, then it creates problems for everybody. So I think that's really important to us. And then as far as the other benefit is, we're a shorter investment life. We're about 6 years, 7, maybe, depending on if there's a call or a put exercised. So it's a very short investment life. Developers tend to like it because they can get out cheaper, and investors like it because they're getting a return on their investment earlier.
Great. Thank you for both of those. Now, shifting a little bit to another question or topic directed to the developers and installers in the audience. What are the requirements that tax investors have for C&I solar? Meaning, what kind of documentation? What's the diligence process? Is there a requirement that a developer has a certain level of experience or track record? And then in particular, where do you see the shortfalls? Where are the developers not meeting the standards that are required, and how can they improve their likelihood of getting taxed?
I mean, for us, I would say that in closing, a lot of things that we come across on a recurring basis are the real estate. I mean, a lot of these C&I deals are the licensing rights are in the PPAs, and there's always a little bit of messiness there. So that's an item. But in terms
You're talking about site control there.
Yeah, I am. I'm talking about site control. Yeah. And then I was gonna go up to the operational perspective in terms of sponsors, where there's probably the most frequent failure point is the timeliness of creating the financial reports or the performance reports. We often see delays in how often the developers are able to produce that stuff. So I would encourage a developer to partner with an asset manager if they haven't done tax equity before, that can help prepare those in kind of a quicker fashion, because it leads to frustrations. And it's not like we would boot the managing member unless they're really a bad actor, but it definitely would streamline the operational process.
Yeah, for the sale leaseback, the focus is perhaps a little bit different, but it's less about post-closing reporting and more about design and construct of the economics of the project. What do I mean by that? Well, the PPA is probably the most operative document, and I think sometimes developers make the mistake of going out and trying to price their power to meet whatever external specification they have to meet, largely, what's the alternative cost from the grid, and not necessarily consider all of the costs of obtaining project financing, including tax equity. And thus, the PPA, at the end of the day, just doesn't throw off sufficient revenue to make a project viable or at least financeable. That said, there are a couple of other things about the PPA that we really look for. One is if site control is embedded therein versus some sort of a site lease or other instrument. We really do care about that, and that the duration of that be longer than the lease term that's negotiated. Secondly, is that the off-taker, who is from the bank's perspective, the primary source of repayment here, that they have to provide financial statements on them. If they're not a public entity, they may not. They wouldn't be in the public domain, and those financial statements should be updated annually. And the PPA is the primary place where that kind of requirement can be in there. And usually there are not objections to that on the part of the kind of counterparty, the off-taker, but it's often something that developers don't think about. So all of a sudden the bank says, hey, do I have rights to check on my primary source of repayment every year, make sure they still have that ability, and we come up short. So those are the kinds of things that I think developers should think about. In an ideal world, there is some uniformity amongst the document set that is used. The site lease, if that's the method of site control, works well with the PPA. If there is another revenue stream, be it SREX or some state level grant, that's blended in as well. Who controls all that? That's the kind of thing that we look for to make a project financeable in the context of the sale leaseback.
Great. And I will say that we have at Energetic Insurance have seen some common things about site control language, about the need for financial statements, also the economics. We see a lot of deals that look like they could be really exciting, but the PPA was priced too low. And the installer or developer, when they did that, and by the time it gets to one of you guys, and then it's just the economics don't work. So I presume that you're both open to having early discussions with developers if they want to throw some pricing by you to see whether that might work or not. I would also say that Energetic has on the PPA side, in the clauses in the PPA, we have worked off the SIA standard form PPA, made some modifications related to our product, as well as to some of the other issues that we brought up, namely around site control, and happy to provide that and any guidance that we can on how to make the better projects for primed for tax equity and debt. And on that theme, I mean, standardization is like, I think we talked on our prep call here that a lot of C&I seems to have been evolved out of the utility scale market. So size of transaction that can bear higher legal fees, more intense diligence process, more sophisticated contracts and structures, that those costs are often fixed and can't be really borne on a smaller 1, 2, 3 megawatt project. Is there a way, and here's the question, is there a way for us to maybe pull some more lessons from residential, which is more of a replicable structure, a little more cookie cutter, less negotiation, less complexity, more apt for volume and scale, Do you guys see that happening in C&I and or not? And how could we make that happen?
Yeah, I mean, I would say that we definitely have seen it. We're working with a developer right now on a huge array of projects that are 100 kilowatts each, maybe plus or minus 25 kW. Where we've looked at their template documents, we have our partnership documents, we've established the tranching protocols and the due diligence framework. The advisors that we've hired are doing all their work on a programmatic basis. So the appraiser is doing kind of a master appraisal and a bring down. And then as we tranche projects, we're really highlighting exceptions from the form documents. So, this is the first case where we're doing, a portfolio of more than 20 projects with a developer under one master partnership using that approach. And we're able to realize pretty significant transaction cost efficiencies. I mean, the upfront legal expense for preparing the partnership documents, it's hard to get away from that. I mean, you're going to see those costs be high anyway, but if you can reuse your documents over and over and over again, and you're just focused on just tranching exercises, you can really save a lot of money. So what I would say is, for us, we like to see, again, developers with pipelines, or at least some aspect of growth, so that we know that when we put our time and effort into forming a partnership with them, and spend the 25 to 50K in preparing legal documents, that we can reuse those over and over and over. And that's how the developers are going to realize the economies of scale benefits that maybe utility scale should be thinking about as well. But at least we've seen it and we like it, and it's working.
Yeah, in our world, what we have been able to do is develop a suite of lease documents, and all of the attendant documents conform with it. We work with a singular law firm who also, when necessary, does the tax opinions. And we have gotten those investor banks I described earlier all to kind of buy into that approach. So there is a level of standardization now that we, Verdant, can offer, even if we don't know up front which of the several banks will play along. It seems the larger you get to the bulge banks, as Peter likes to call them, the ability to impose some level of standardization versus being forced to use that issuing bank's document set seems to minimize, and therefore execution costs for the developer can go up. So there's actually some, but whether it's Peter's group or Verdant or another finance entity, there is some value in partnering consistently on your project flow with a source that can help you bring standardization to all of the activities that surround financing. So we also look at developers who have a pipeline of projects that we can leverage what can be somewhat daunting initial upfront costs, so that by duplication we start to get those efficiencies.
Okay.
I mean, I would just reemphasize that, from both a developer, well, actually from an investor capital raising perspective, the more that this looks like a product that fits in a box, the better off we're all going to be, because it's easier to raise capital. You're not deviating from what's in the sandbox. And to the extent that we can create a program that we don't deviate from and that's clearly understood, and you can put a nice box around it and a bow on it, you can really drive economies of scale benefit. And ultimately at Greenprint, our goal is to bring kind of utility scale pricing down to the C&I level. Obviously, we're not able to do that yet because the market's so fragmented. The bulge banks aren't really necessarily interested in doing this quite yet. So we're trying to find scale in other ways.
I couldn't agree more.
So on this idea of kind of creating more replicable processes, you guys have also been talking about a way to work together to provide more tax dollars with more of an ideal investment structure. Do you guys want to attack the question of, is there a one size fits all structure? We talked about the differences. Is there a one size fits all possibility for C&I solar for tax?
Peter, I'll take a stab at sort of describing our rough discussion so far, if you don't mind. At the end of the day, the sale leaseback is kind of a simple transaction, whereas where there's a lessor and there's a lessee. Sometimes finding that party to serve as lessor is challenging, and Verdant has gone out and dealt with primarily regional banks that have that prerequisite equipment finance orientation. But even that world is somewhat limited, and some banks don't really want to play in a space that has a lot of moving parts. Others don't have meaningful tax appetite. So there's a lot of reasons why even that world is limited. The whole world of family office or high net worth individuals coming into these projects has always intrigued me, but it has been somewhat difficult to blend that kind of an investor profile into the projects that we have initiated. So Peter and I have been talking about sort of using his expertise, his contacts, and his credibility within Greenprint to form a master lessor, where the tax equity would be provided by the kinds of investors with whom Peter regularly interacts, and the transaction structuring would still be that efficient single investor sale leaseback. It just so happens that the single investor is some sort of a master partnership with pre-identified sources of debt to leverage the tax equity that Peter's group can bring to the table. Is that a fair description, Peter, so far?
Yeah, I think so. I mean, we've had a number of banks that were focused on sale leasebacks originally, and since have ran out of tax appetite, and so we've looked at syndicating the sale leaseback via kind of an upper tier where you bifurcate the tax investment structure and the equity side, and then you can provide debt and tax equity in separate tranches. So I think that the syndication model is similar, and it actually is pretty interesting, regarding doing it on top of the sale leaseback. So this is where the sale leaseback prevails from an investment perspective is, if the developer or the project is not able to make its lease payments, it's a hell or high water situation. So the collateral package is really pretty strong. You can foreclose and own that project. So I would say that definitely accurate, definitely an interesting idea of creating kind of the partnership flip on top of the sale leaseback and then fundraising together. I think we talked about this a little bit yesterday, but there are some investors that won't be able to use the leasing structures, and that's because they may be deemed in quotes active in the space, and by definition, leasing is a passive activity. So we just need to keep eyes on that and only really match up the right investors with that structure. But I definitely think that there are some good ideas here, and it could get a lot of traction.
Yeah, it's really exciting for us as at Energetic to see this kind of creativity and problem solving for different use cases to unlock more tax appetite in the space. As we were talking, we did get an audience question in, and I think this is an interesting one because as you get to smaller projects, there are certain costs that are just not going to go away, and so to try to think about doing tax equity on a 100 kilowatt project is going to be complicated unless it was a private individual. So the question is I think one I've heard before, and it's about how do you create more of a programmatic approach to apply tax equity to smaller projects. So he's giving the example of 100 kilowatt projects. There's a group of them, and they're going to have ultimately 100 to 200 projects, but they're going to do them in 10 projects at a time. So 1 megawatt tranches. But up to 1 megawatt tranches up to what looks to be about 10 to 20 total megawatts. Do you guys have any way of addressing that kind of situation where you're doing things in tranches and there's a cost issue, but also is there even the diligence? If they were different off takers, would you be able to do the diligence or want to do the diligence on that?
Yeah, I think that's the first question. Is this are these all unique and different off-takers, or are these sites within the same off-taker? Is there some combination of both? But let's assume the more complex of those alternatives, which is that we have unique off-takers, each wanting 100 kW installations, and we have to somehow blend that together. The finance world is accustomed to smaller ticket, diverse, let's call them borrowers, or diverse repayment source pools of transactions, portfolios. In my world of equipment finance, portfolios of different off-takers or different lessees get financed all of the time. There have to be some common elements in that. If each of these 100 kW projects has its own unique PPA and different site lease arrangements and all of that, you're just not going to get to the economies we're talking about. So let's assume foundationally that there are some standardization within the documents. And then it's a matter of kind of taking a portfolio approach to the cash flows, the combined cash flows. And, a tranche of 10 distributed generation, smaller end projects in the C&I space is doable. I think there would be a role to play for Energetic, for example, or an insurer who could sort of take a pocket of the risk associated with, one or two problems within a portfolio and help, the ultimate investors to understand that their risk mitigation is really in the diversification of those repayment sources. Now, I'm talking about, the cash flow investor who may be the same party as the tax equity in a sale leaseback, or maybe the debt source in a flip. So I'm more focused on the cash risk, which surrounds, a basket of different off-takers. But Peter, I'll throw it up to you. Do you feel like there's easy ways to address portfolios with the flip that maybe are a little more comprehensive than the sale leaseback model?
No, I mean, I think you said everything that we would think about as well. The only nuances there is, I think when you look at a kind of a diversified cash flow stream, we wouldn't necessarily lump that together. I think broad diversification is a huge value from an investment perspective, and it's often the overlooked value of C&I from an investment perspective. With utility scale, you have high concentration risk, and so you got to spend tons of money on transaction costs, belt and suspendering. With C&I, it is kind of like the residential approach where, if you lose one project out of your portfolio, it's probably not a huge deal. Each project we do price tax equity a check individually. We try to tranche projects in a project company. So, a project company could actually hold multiple projects on a time basis. So, let's just say, for example, the sponsor and us agree to quarterly tranching. So then every quarter we create a project company, do an asset purchase agreement, drop all those assets into the project company, and then the tax equity would be sized for each project, but then aggregated into kind of a master tranching schedule. So that's kind of how we would approach that scenario. But we didn't even touch on that today, but maybe for further discussion in the future is, when is a project company necessary? Is it on every single project basis, or is it on a tranche basis? But I think you answered it well. I don't have anything else to add aside from what I said. So thank you.
Great. Well, we're about at the end of time. I want to thank you both. At Energetic Insurance, we are in this unique position because we get to talk to all kinds of tax investors, lenders, non-bank lenders, commercial bank lenders, developers, other stakeholders, installers. So, and they all tell us, about what they're working on. We're not competitive with any of them, so we get to understand and have really candid conversations about what they're doing, what their strengths are, what their weaknesses are, and I think both John and Peter are two people where I feel like every time I talk to you, I understand. I learned something new, and that's really valuable for us and me to have. And I hope that the audience also got value out of that today. Feel free, audience members, if you ever want to know, hey, I'm thinking about this, what type of acquirer might be interested right now, who has appetite of this project, or what kind of bank might have appetite for this type of project. We try to do a good job about collecting those data points, and are happy to share that with the market, because if you guys can transact more projects, everyone in the audience, then we can have more opportunities for insurance. And so there's a symbiotic relationship there. So thank you guys again. And, I would like to hand the mic back over to Nico to wrap up. Nico, are you there?
Absolutely. Man, it's so exciting and interesting to hear the way that you guys are thinking about not only deploying capital, but helping those in our industry who really are trying to grapple with building something of value, building something of worth. They don't know all the pieces and the parts that come together. And it's great to be able to engage and indeed watch, from my perspective, the thought leadership that you guys are bringing to market. It's so clear to me, and I know to the audience, that you guys are truly thinking in innovative ways, which is why we invited you to join us here on today's innovation track. Super grateful for you, Jim, Peter, and John. Thank you for this session. The audience has been firing a bunch of comments back and forth on the various social channels that will filter back to you guys as well. It seems that folks really enjoyed this session. And with that, I'm going to say goodbye to you guys as I bring up really quick one more thank you. And one last final thank you to you, Jim, for helping coordinate and bring this esteemed panel into the forefront. Thanks so much, guys.
Enjoyed it. Thank you.
Absolutely. Thanks. Well, I want to take a moment here before you all run away to the next session and thank our main sponsor, SunGrow, and our track sponsor, Radiant REIT. Many of you are probably familiar with these names, but in the event that you are not, Suncast Summit is being brought to you by SunGrow, the world's most bankable inverter manufacturer with an industry-leading production capacity of 50 gigawatts. SunGrow is consistently the inverter of choice for EPCs, developers in the United States and around the world. You can find out more at sungrowpower.com. And Radiant REIT as well. You can learn more at radiantreit.com. It's the first ever investment trust to bring the mortgage REIT to the solar energy market. Radiant REIT's approach delivers the benefits of healthy balance sheets and self-ownership to project developers looking to lower their cost of capital. And if you have not joined any of our additional sessions, sorry, I forgot to pull you guys down there. Sorry about that. And if you haven't joined any of our our other sessions on Suncast Summit, I would invite you to do so. You can look at suncastsummit.com to learn more. Thank you for joining us on LinkedIn Live, on Facebook, Twitter, YouTube, and other avenues of those of you who found out instantaneously that we were broadcasting. And I'm really grateful for those who registered ahead of time and joined us on Crowdcast and engaged with our esteemed panel here and many others. So we have 2 more sessions and 1 product showcase that is about to kick off right now. If you are not registered for those, please go to suncastsummit.com and check it out. And the last sort of PSA as we run down the last moment of the session, if you have not joined yet our Facebook group, it's called Clean Energy Guild. If you want to continue the conversation with Jim, myself, and many others in our community, join us there in Facebook at the Clean Energy Guild, a place where you can connect, find mentorship, give mentorship, learn about others doing great work in the clean energy space, if Facebook is your thing. And I think we're going to be giving away I'm pretty sure we're giving away a 1-year membership to our private Suncast Guild, which is sort of the next layer beyond the Clean Energy Guild, where we have exclusive content, exclusive interviews, and Ask Me Anythings with folks like Jim Bowen at Energetic Insurance, and where we highlight ways that you can learn and grow your business or your career in the clean economy. So with that, we're going to sign off here. Remember, you are what you listen to, or in this case, what you watch. Thanks for giving us the one non-renewable resource that you can today, you won't ever get back, and that's your time. I hope that it was a great investment for you. We'll see you on the next sessions, and I'm so grateful that you spent your time with us.